If you clicked on this video, it probably means you're curious. You want to know what the top 2% understand about money, investing, and building real wealth. You might not have a finance degree. You might not be on Wall Street. But you know there's something the wealthy are doing differently, and you want to figure it out. Good news, you're about to. Because what I'm about to show you is something Warren Buffett, one of the richest people on the planet, has used for decades. It's a way of looking at a business that's so simple you might even wonder, why doesn't everyone do this? Well, because only 2% actually do. Most people chase hype. They listen to noise. But Buffett? He looks at 5 numbers, just 5 simple things, and in a matter of seconds, he knows whether a company is solid or not. Today, you're going to learn exactly what those 5 things are. And by the end of this video, you'll be able to look at a balance sheet. Yes, even if you've never done that before, and say with confidence, this is a business I trust. Or not. Let's get started. Now first, we need to understand one basic tool, the balance sheet. Don't worry, it's not complicated. Think of it as a snapshot of what a company owns and what it owes. That's it. On one side, the assets. On the other side, the liabilities and the shareholders' equity. Assets equals liabilities plus equity. That's the basic equation, and that equation has to stay in balance, always. Now let's get into Buffett's 5 rules of thumb. These are like filters. If a company passes them, great. If it fails, Buffett walks away. Rule number 1, more cash than debt. The first thing Buffett looks at is simple. Does the company have more cash than debt? He adds up all the company's cash and short-term investments, what they have in the bank, and compares it to how much debt they owe. If cash is greater than debt, that's a green light. Why does this matter? Because companies that have more cash than debt don't rely on borrowing to survive. They generate enough money to run their business without needing constant loans. That's a strong sign. If you were choosing a roommate, would you pick the one with a giant savings account and no credit card debt? Or the one drowning in bills? Exactly. Rule number 2, a low debt-to-equity ratio. Next up is the debt-to-equity ratio. Sounds technical, but it's easy. You take the total liabilities and divide them by the total equity. Buffett likes this number to be below 0.8. Why? Because it shows that the company is mostly funding itself through profits and shareholder investment, not through debt. A company that's highly leveraged might be growing fast, but it's also taking big risks. And Buffett? He likes to sleep at night. So he wants businesses that are financially stable and don't owe the bank everything. Rule number 3, no preferred stock. Now this one is almost too simple. Buffett wants to see 0 preferred stock on the balance sheet. Why? Preferred stock is kind of like a hybrid between debt and equity. It usually comes with fixed dividends and can be a sign that a company needed extra money and had to sweeten the deal for investors. Strong businesses don't need to do that. If a company doesn't have any preferred stock, Buffett takes that as a sign of financial strength. They're not desperate. They're in control. Rule number 4, growing retained earnings. This one might be the most important. Retained earnings. Retained earnings are simply the profits a company has kept and reinvested, rather than paying them all out as dividends. Think of it like a rainy day fund that also fuels future growth. Buffett looks at the trend. Is retained earnings consistently growing? Especially during hard times, like recessions or slowdowns? If yes, that's a major green flag. It means the company isn't just profitable. It's wisely using those profits to build a stronger future. Rule number 5, positive treasury stock. This one surprises people. Buffett actually likes to see a company with treasury stock. That means the company has been buying back its own shares over time. Why is that good? Because it shows management believes in the value of their business. Instead of expanding recklessly or hoarding cash, they're giving value back to shareholders. Buybacks also reduce the number of shares in circulation, which can increase the value of each remaining share. So when Buffett sees treasury stock on the balance sheet, that's another thumbs up. All right, that's the checklist. 1. More cash than debt. 2. Low debt-to-equity ratio, below 0.8. 3. No preferred stock. 4th, consistent growth in retained earnings. 5. Positive treasury stock. But now you might be thinking, okay, this all sounds great, but does it actually work? Let's take a real example. Chipotle. Chipotle is a company that Buffett has admired for its strong fundamentals. So let's see how it stacks up against these 5 rules. Rule 1. Cash versus debt. Chipotle has over $1.4 billion in cash and short-term investments. And their debt? Practically zero. Check. Rule 2. Debt-to-equity ratio? Now this one gets tricky. The raw number is around 1.2, which fails the 0.8 test. But when you dig deeper, you realize most of that debt comes from long-term leases. They rent restaurant space. That's not quite the same as being in financial trouble. Plus, Chipotle has billions in treasury stock, which affects the equity number. So with some nuance, this might still get a check. Rule 3. Preferred stock? None. 0. Just how Buffett likes it. Rule 4. Retained earnings? Consistently growing for years, including during tough times like 2020. Another big check. Rule 5. Treasury stock? They've spent over $5 billion buying back their own shares. That shows confidence and commitment to shareholders. Check. So does Chipotle pass Buffett's test? Mostly, yes. And more importantly, you can now analyze any company the same way. Here's the bigger lesson though. You don't need to be a genius. You don't need a complicated model. You just need a clear checklist and the discipline to stick to it. The top 2% of investors? They're not the ones glued to CNBC or chasing the next crypto rocket. They're the ones who quietly, patiently build their portfolio based on timeless principles. It's not sexy, but it works. And now you know what they know. You know how to analyze a balance sheet like Warren Buffett. You know how to spot financial strength at a glance. And maybe most importantly, you know what not to do. Don't chase hype. Don't bet everything on the next trend. Don't ignore the fundamentals. Now here's the challenge. Pick a company you like. Pull up its balance sheet. Run through the 5 rules. How does it stack up? Start doing that once a week. It only takes a few minutes. But over time, you'll build the muscle Buffett has spent a lifetime refining. Still wondering why only 2% get this? Because 98% of people don't take the time to look under the hood. They buy stocks like lottery tickets. But you're learning to invest like a business owner. You're no longer just watching the game, you're playing it. And if you keep showing up, learning, and applying what you now know, you won't just be watching the wealthy. You'll be one of them. But before we wrap up, let's take this one step further. You see, understanding these 5 rules is powerful. But applying them consistently? That's where the real transformation happens. Think of it this way. Imagine you're building a house. Every time you analyze a company using Buffett's rules, you're laying down bricks. Strong, solid bricks. And over time, you're not just learning to invest. You're building your own financial fortress, one that can weather storms, corrections, even recessions. Let me share a quick story. In the early 2000s, there were dozens of flashy tech companies. They had no profits, some had no real products, but their stock prices were exploding. It was easy to get caught up in the hype, and many people did. But Buffett? He sat out. People laughed at him, said he didn't get the new economy. Then the bubble burst. And guess what? Buffett's companies? They were fine, solid, profitable. The hype vanished, but value remained. That's what these 5 rules are about. Avoiding landmines, focusing on real value, protecting your downside so you can stay in the game long enough for compounding to work its magic. Because here's the truth. Investing isn't about striking it rich overnight. It's about making a series of smart decisions over time. That's how wealth is built. That's how freedom is earned. And that's exactly what the top 2% understand. They don't get rich because they're lucky. They get rich because they're consistent. They do the boring stuff, the disciplined stuff, the stuff that works. So if you've made it this far into the video, you're not just interested, you're committed. And that puts you ahead of most. Here's a final tip. Print out these 5 rules. Tape them next to your computer. Every time you hear about a hot stock or next big thing, pause. Look at the balance sheet. Run it through the checklist. Most won't pass, that's the point. But when one does, you'll know it's not just hype, it's real. And when you invest in real value over and over again, your wealth won't just grow, it'll last.